All right, let's dive into the strategic evolution of ITC Limited. For years, if you wanted to invest in the tobacco industry in India, ITC was your go-to. But that's changing. The company has spent the last 5 years on a massive transformation, and now it's standing at a major crossroads, really pivoting to become a huge, diversified Indian consumption powerhouse. So to really get a handle on this story, we're going to look at it through 3 key lenses. First, we'll cover the company's fundamental state, and it is strong. We're talking high return on equity, steady dividends, and zero debt on the balance sheet. Second, we'll unpack the strategic direction that's powering this shift, things like the ITC Next strategy and the big hotel demerger. And finally, we'll look at the market opportunity, which is all about the recent volatility that some are seeing as a strategic accumulation zone. The real tension here, and what makes this so interesting, is this clash between a very solid long-term strategy and a very specific short-term market event.
So how did ITC even get to this point? Well, this wasn't some overnight decision. This is the result of a very deliberate 5-year structural cleanup. They've essentially reshaped the company's entire foundation, and that's what has set the stage for the challenge they're facing right now.
This timeline here really maps out that journey for us. It all started back in 2021-22 with the post-COVID recovery, which saw cigarette volumes bounce back. Then a huge commitment was made in August 2023 when the board gave the green light for the hotels business demerger. This all led to a peak in fiscal year 2024, with the share price soaring to all-time highs of over 500 rupees. A really critical milestone was hit in January 2025 when ITC Hotels was listed, a move that seriously uncluttered the mean company's balance sheet. And that brings us right up to today's test in January 2026, a new central tax notification that's stirring up a lot of market volatility. Now, the engine behind all this change is a very clear blueprint for the future. It's a strategy called ITC Next, and its entire purpose is to build a resilient, future-proof company that goes way beyond its legacy tobacco business.
I think Chairman Sanjiv Puri put it perfectly with this quote: "Management isn't just defending the fort, they are building a new castle." And that really captures the 3 pillars of the strategy. First up is premiumization, which is all about moving up the value chain to protect their margins. Second is a digital-first approach, really scaling up their direct-to-consumer businesses. And third, you've got inorganic growth, which we've seen in action with the successful integration of acquisitions like 24 Mantra.
That hotel demerger in January 2025 was a massive piece of this puzzle. As you can see here, the hotels business used to be just one part of the bigger conglomerate. The demerger spun it off into its own publicly listed company, ITC Hotels Limited. Now, why was this so important? Well, it shifted the parent company to what's called an asset-right model. In simple terms, it improved their return on equity and let them focus their capital on the high-growth areas, like the FMCG and digital businesses.
And has that focused spending paid off? The results are pretty undeniable. Just take a look at this chart. It shows the FMCG segment's EBITDA margin just climbing steadily over the last 5 years, now hitting over 11.5%. This segment now makes up over a quarter of the company's revenue, and it's growing at a double-digit rate. The real key takeaway here is that the FMCG business isn't a startup anymore, being funded by another division. It's hit a tipping point. It is now a self-sustaining, profitable growth engine all on its own.
But hold on, all this ambitious pivoting, it takes a lot of capital, right? So where is all that money coming from? That brings us to the financial heart of the company, the unwavering cash engine that's been fueling this entire transition from day one.
And the fuel for that engine is, of course, the legacy cigarette business. As this slide shows, it's protected by a really formidable moat. We're talking about an unparalleled distribution network and some pretty significant regulatory barriers to entry. This has allowed ITC to command a dominant, roughly 75% share of the organized market. And it's this division that generates the massive, incredibly resilient free cash flows needed to fund the whole strategic pivot into FMCG and digital.
Okay, so the strategy is clear and the funding is solid. But now we have to turn to the central challenge, the event that's been causing all this recent market noise. We need to take a really objective look at the immediate regulatory headwind, what's being called the 2026 tax shock.
So let's get into the specifics. Starting February 1st, 2026, a new central tax notification is going to shift the GST regime. It'll be based on the retail sales price with a 40% rate. Now, the projected operational risk is a 6 to 8% drop in volume, and there's also some risk that consumers might downtrade to the illicit markets. The financial impact? Well, we've already seen it. A 20% stock price correction in January 2026, as the market pretty much priced in a worst-case scenario. For their part, management has said they're confident they can navigate this through calibrated pricing, innovation, and by leaning on their unmatched distribution strength.
Okay, so that brings us to our final section. We've laid out the long-term opportunities and the short-term risks. So let's pull it all together and see how the market is currently valuing ITC and what the core investment thesis looks like right now.
This chart right here really illustrates a major valuation dislocation. You can see ITC is currently trading at a price-to-earnings multiple of about 17 to 19 times. Now compare that to the 5-year average for its consumer peers, which is way up there at over 35 times. The source material calls this a significant valuation gap. So the argument here is that all the jitters over this syntax have created a situation where a company with a 25–30% ROE and a dividend yield around 4% is trading at a really notable discount to its peers.
So let's put it all on the table and balance the risk and reward. The bear case, over on the left, really boils down to 3 key risks. That the February 2026 GST change will cause a big drop in volumes. That a tax hike on unmanufactured tobacco will lead to agri-input inflation, and that institutional ESG constraints will keep a cap on valuation multiples. But on the other side, you've got the bull case. The bulls are pointing to the opportunity. The powerhouse cash generation, a self-sustaining FMCG business with strong margins, much better capital efficiency after the demerger, and a valuation that offers a significant margin of safety.
So, after analyzing all this, what's the final verdict from the source report? It suggests accumulating on the current volatility. The key takeaways presented are: 1. To see budget announcements as noise, not a long-term signal. 2. To focus on the strong fundamentals. We're talking zero debt and a high ROE. And 3, to view the recent technical weakness in the stock as a potential accumulation zone. And this really leaves us with a final powerful thought. ITC is no longer just a proxy for tobacco. It is a diversified, resilient play on the great Indian consumption story.